Listen, I need to tell you something that might make you uncomfortable, but someone has to say it. If you're sitting on a pile of cash right now thinking you're being safe and prudent, you're not protecting yourself. You're slowly destroying your wealth. And I'm not talking about some theoretical loss you might experience someday. I'm talking about a mathematical certainty that's happening to your money right now, today, this very second. Every dollar sitting in your savings account is worth less than it was yesterday, and tomorrow it'll be worth even less than it is today. This isn't opinion, this is arithmetic. And the arithmetic is brutal. Now, before you tell me I don't understand your situation, before you explain why your case is different, let me tell you about 1974. I had just started managing money professionally. I'd studied economics at Cambridge. I thought I understood markets. And I made what I believed was the safest decision possible. I held a significant portion of my portfolio in cash because the market looked dangerous. Inflation was running hot. Stocks were volatile. Everything felt uncertain. So I did what felt safe. I held cash, and I watched that cash lose 12% of its purchasing power in a single year. Not because I made a bad trade, not because I picked the wrong stock, but because I did nothing. I held what I thought was the safest asset in the world, and it evaporated like water in the desert. That year taught me something that changed how I think about money forever. Safety is an illusion, and sometimes the thing that feels safest is actually the most dangerous choice you can make. If this resonates with you, hit that like button right now. So here's what I'm going to give you today. I'm going to show you exactly why cash is dangerous in 2026. Not just dangerous, deadly. I'm going to break down the mathematics of wealth destruction, and then I'm going to give you a 7-step plan to move from cash into assets that actually protect your purchasing power. This isn't about taking wild risks. This isn't about gambling. This is about understanding what money actually is and how inflation works. Because if you don't understand inflation, you don't understand money. And if you don't understand money, you're going to stay poor no matter how much cash you think you have. Let me explain the problem we're facing right now. Inflation in the United States has averaged around 3% over the past few years. The Federal Reserve tells you they're targeting 2%, but let's be honest about what's actually happening to prices. Your groceries cost more. Your insurance costs more. Your utilities cost more. Everything costs more. And that 3% number they're reporting, that's probably understating reality for most people. But let's be generous and use their number. Let's say inflation is running at 3% annually. Do you know what your savings account is paying you? Maybe 0.5%. Maybe 1% if you shopped around and found one of those high-yield accounts everyone talks about. So you're earning 1% and losing 3%. That's a net loss of 2% every single year. You're not preserving wealth. You're bleeding it. Now let me show you what this actually means in real dollars because percentages don't hit hard enough. Let's say you have $100,000 in cash. That feels like a lot of money. It feels safe sitting there in your account. But in 1 year, with 3% inflation, that $100,000 only buys what $97,000 bought last year. You lost $3,000 of purchasing power by doing absolutely nothing. In 5 years, your $100,000 is worth $85,973 in today's dollars. In 10 years, it's worth $73,742. You will have lost over $26,000 in purchasing power, and that's assuming inflation stays at 3%. What if it goes higher? What if we see another spike like we did in 2021 and 2022 when inflation hit 7%, 8%, 9%? Your cash gets obliterated even faster. But here's what makes this truly insidious. You still see $100,000 in your account. The number doesn't change. The bank statement shows the same amount, so you feel like you still have your money. But you don't. You have the same number of dollars, but those dollars buy less. This is how inflation steals from you. It's silent, it's invisible, and by the time you realize what happened, years of your purchasing power are gone forever. You can't get them back. The erosion is permanent. Now I know what some of you are thinking. But I need cash for emergencies. I need liquidity. I need security. And you're right. You do need some cash. But let me ask you this. How much do you actually need? Most financial advisors will tell you to keep 3 to 6 months of expenses in cash. That's reasonable. That's smart. But I meet people all the time who have 1 year, 2 years, 3 years of expenses sitting in cash. They're holding hundreds of thousands of dollars earning nothing, losing value every single day, and they call it being responsible. That's not responsible. That's fear. And fear is expensive. Let me ask you something honest. Are you holding cash because you genuinely need that liquidity? Or are you holding it because you're scared of what might happen if you invest it? If the real reason is fear, if you're worried about market crashes or losing money, comment your specific concern below and finish with, "But I will win this fight." Sometimes admitting what's really holding you back is the first step toward making better decisions. Here's what you need to understand about risk. Everyone thinks holding cash is low risk. It feels safe because the number in your account doesn't go down. But inflation risk is still risk. In fact, it's the most certain risk there is. With stocks, there's a chance the market goes down. With bonds, there's a chance interest rates move against you. With cash, there's a 100% certainty that inflation will erode your purchasing power. You're not avoiding risk by holding cash. You're just choosing a different type of risk. And you're choosing the one type of risk that's guaranteed to hurt you. Now let's talk about opportunity cost, because this is where holding cash really destroys wealth. Every dollar sitting in cash is a dollar that's not invested. It's not growing. It's not compounding. It's just sitting there losing value. The stock market has returned an average of about 10% annually over the long term. Let's be conservative and say you could earn 7% in a diversified portfolio. If you invest $100,000 and earn 7% annually for 10 years, you end up with $196,715. That's nearly double your money. If you hold that same $100,000 in cash earning 1% for 10 years, you end up with $110,462. But remember, inflation ate away at that purchasing power. So in real terms, you have about $82,000 worth of buying power. You didn't just miss out on gains. You went backwards. The person who invested turned $100,000 into nearly $200,000. You turned $100,000 into $82,000. That's a $114,000 difference. That's not a small mistake. That's a life-changing mistake. And this compounds over time. This is what people don't understand about compound growth. It's not just about the returns you earn. It's about the returns on your returns. When you invest, your money makes money, and then that money makes money. It snowballs. It accelerates. But when you hold cash, there's no compounding. There's just slow erosion. You're standing still while everyone else is moving forward. And in the world of money, standing still means falling behind. Let me tell you what I see happen to people who hold too much cash. They wait. They wait for the perfect moment to invest. They wait for the market to pull back. They wait for certainty. And while they're waiting, years go by. The market goes up without them. Their cash loses value. And eventually they realize they've been waiting for a perfect moment that never came, and they've paid an enormous price for that wait. I've seen this happen over and over again in my 50 years in this business. The people who wait for perfect conditions never invest. And the people who never invest never build wealth. It's that simple. Now here's the part that makes this even worse. The people who hold large amounts of cash don't just lose the opportunity for growth. They also lose protection against the very thing they're worried about. They're holding cash because they're worried about economic uncertainty, about market crashes, about losing money. But cash is the worst protection against economic uncertainty. When the economy struggles, when crises hit, what happens? Governments print money. They stimulate. They increase the money supply. And when the money supply increases, inflation goes up. and your cash loses value even faster. You're using the worst possible tool to protect yourself from the thing you're afraid of. So here's the plan. 7 specific steps to move from cash into assets that protect your wealth. Each step has a timeline. Each step has specific actions. By the end of this plan, you'll know exactly what to do in February, what to do in April, what to do in July, and where you need to be by December. This isn't theory. This is the exact framework I use to think about cash versus investments. Let's start with Step 1. Step 1 takes place in February, and it's about calculating your real cash needs, not what feels safe, not some arbitrary number. Your actual cash needs based on mathematics. Here's how you do this. Add up all your essential monthly expenses: mortgage or rent, utilities, food, insurance, transportation, minimum debt payments. Don't include discretionary spending. Don't include entertainment or dining out. Just the absolute essentials. Multiply that number by 6. That's your emergency fund. For most people, this is somewhere between $15,000 and $40,000. Everything above that number is excess cash that should be invested. Let me give you a concrete example. If your essential expenses are $4,000 per month, you need $24,000 in cash. If you have $80,000 sitting in savings, you have $56,000 of excess cash that's losing value every single day. That $56,000 needs to go to work. But here's what most people do wrong. They don't separate essential from non-essential. They include their vacation fund, their shopping budget, their entertainment spending in their expense calculation, and suddenly they think they need $70,000 in cash for emergencies. That's not an emergency fund. That's a lifestyle fund. And it's costing you a fortune in lost growth. Step 2 happens in March, and it's about setting up your investment accounts if you don't already have them. You need a brokerage account. You need a Roth IRA if you're eligible. You need a traditional IRA or 401k for tax-advantaged growth. This step should take you 1 week maximum. Don't overthink it. Pick a major brokerage: Vanguard, Fidelity, Schwab. They're all fine. Open the accounts, fund them, move on. The biggest mistake people make here is analysis paralysis. They spend months researching the perfect brokerage, the perfect account type, the perfect time to open it. Stop. Just open the accounts. Every day you delay is another day your cash is losing value. Subscribe to this channel if you want weekly strategies based on 50 years of real market experience. No hype, just what actually works. Step 3 takes place in April, and this is where you start moving money. Take 25% of your excess cash and invest it immediately. If you have $56,000 of excess cash, that's $14,000 going into the market right now. Where does it go? Into a simple, diversified portfolio. 60% in a total U.S. stock market index fund, 30% in a total international stock market index fund, 10% in a short-term bond fund. This is not complicated. You don't need to pick individual stocks. You don't need to time the market. You just need to own the market. The U.S. stock market index fund gives you exposure to the entire U.S. economy. The international fund gives you global diversification. The bond fund gives you a small cushion. This is the foundation of every smart portfolio I've ever built. Now, some of you are already panicking. But what if the market crashes right after I invest? What if I buy at the top? Here's the truth. You might. The market might go down next month. It might go down next year. And if it does, your $14,000 might temporarily be worth $12,000. But you know what's certain? Your cash will definitely be worth less due to inflation. You're not choosing between risk and safety. You're choosing between definite loss and possible temporary loss. And possible temporary loss beats definite permanent loss every single time. Step 4 happens in June, and you're going to invest another 25% of your excess cash. That's another $14,000 into the same portfolio, same allocation. 60% U.S. stocks, 30% international, 10% bonds. Why are we spreading this out over multiple months? Because it reduces the impact of bad timing. This is called dollar cost averaging, and it's one of the most effective ways to invest when you're moving a large sum from cash. Instead of putting everything in at once and potentially buying at a peak, you spread your purchases over several months. Sometimes you'll buy when the market is up, sometimes you'll buy when it's down. Over time, it averages out, and you eliminate the psychological torture of trying to time the perfect entry point. Step 5 takes place in August, and this is where you invest another 25% of your excess cash, another $14,000 into the market. You're starting to see a pattern here. We're methodically moving money from a depreciating asset into appreciating assets. We're doing it gradually to smooth out volatility, and we're doing it consistently regardless of what the market is doing. This is how you build wealth, not by making brilliant market calls, not by finding the next hot stock, but by consistently moving money from low-return assets into higher-return assets. It's boring, it's not exciting, but it works, and it works far better than any complicated strategy you'll ever find. Now here's what's going to happen during these months. You're going to see your portfolio fluctuate. Some days it'll be up, some days it'll be down, and you're going to be tempted to stop. You're going to think maybe I should wait until things calm down. Maybe I should hold off until the market looks better. Don't. This is the test. This is where most people fail. They start the process, they see some volatility, and they panic. They go back to holding cash because it feels safer, and they guarantee themselves a lifetime of underperformance. The market is always uncertain. There is never a perfect time. If you wait for certainty, you'll wait forever. Step 6 happens in October, and you're investing the final 25% of your excess cash. The last $14,000 goes into the market. Same allocation, same portfolio. By now, you've moved all of your excess cash into investments. You still have your 6-month emergency fund sitting safely in a high-yield savings account. But everything above that is now working for you. It's earning returns. It's compounding. It's keeping pace with or exceeding inflation. You've transformed from someone who's losing purchasing power every day into someone who's building wealth. If you know someone paralyzed by fear and sitting on too much cash, share this video with them. Sometimes the best thing you can do for someone is give them the information they need at exactly the right time. Step 7 is ongoing, and it happens from November through the end of the year and beyond. This is about maintaining discipline and continuing to invest. Every month, every single month, you take new savings and you invest them. You don't let cash pile up again. You don't fall back into old habits. When you get paid, you pay yourself first by investing before you spend on anything else. Most people do this backwards. They spend first, and if there's anything left over, maybe they invest it. That's why most people stay broke. You need to flip that. Invest first. The specific amount doesn't matter as much as the consistency. Whether it's $500 a month or $5,000 a month, you invest it automatically. You set up automatic transfers from your checking account to your investment account. You remove the decision from your daily life. Because the moment investing becomes a choice you make each month, the moment it requires willpower or discipline, you'll find excuses not to do it. You'll tell yourself you'll invest next month when you have more money. You'll tell yourself you'll wait until the market pulls back. Automate it. Make it non-negotiable. Make it as automatic as paying your mortgage or your electric bill. Now let me tell you what's going to happen over the next 5 to 10 years if you follow this plan. Your portfolio is going to grow, not in a straight line. There will be years when it goes down. There will be months when you question everything. But over time, the mathematics work in your favor. The stock market has never had a negative return over any 20-year period in history. Never. If you hold a diversified portfolio for 2 decades, you make money. It's as close to a guarantee as you'll ever find in investing. Meanwhile, your friends and family who are holding cash, they're going to watch their purchasing power erode year after year. They're going to complain about inflation. They're going to wonder why they can't get ahead, and it's because they're using the wrong tool. They're trying to build wealth with an asset that's designed to lose value. Let me address the elephant in the room. What if there's a recession? What if the market crashes? What if everything goes down? First, understand that recessions and market crashes are normal. They happen. They've always happened. They'll keep happening. In my 50 years in this business, I've seen multiple recessions, multiple bear markets, multiple crises, the dot-com crash, the 2008 financial crisis, the COVID pandemic crash. Every single time, people holding cash thought they were smart. They thought they'd avoided the pain. But what they actually did was guarantee they'd miss the recovery. Because here's what happens after every crash. The market recovers. It always has. And the people who stayed invested, who kept buying during the downturn, they're the ones who built fortunes. The people who sold and went to cash, they locked in their losses and missed the bounce back. Second, even in a crash, you're better off invested than in cash. Let's say the market drops 30%. Your $56,000 investment becomes $39,200. That hurts. But if you held cash instead, inflation is eating it at 3% per year. After 3 years, your $56,000 in cash has the purchasing power of about $51,272. The invested money, even after a 30% crash, will likely recover faster than inflation erodes your cash. And if you kept investing during the downturn, if you kept buying when prices were low, you'll end up far ahead of where you started. This is how wealthy people think about crashes. We see them as sales. We see them as opportunities to buy assets at discount prices. Poor people see crashes as disasters. Rich people see crashes as wealth-building moments. Now here's the discipline test. This is where I separate people who actually want to build wealth from people who just like talking about it. Following this plan requires you to do things that feel uncomfortable. It requires you to invest when the news is scary. It requires you to watch your account balance fluctuate without panicking. It requires you to trust mathematics over emotions. Most people can't do it. They say they want to build wealth, but when it comes time to actually move money out of cash and into investments, they freeze. They make excuses. They find reasons to wait. And waiting costs them everything. I need you to be honest with yourself right now. Are you going to do this? Are you actually going to calculate your real emergency fund needs and invest the excess? Are you going to set up automatic monthly investments? Or are you going to watch this video, nod along, agree with everything I said, and then do nothing? Because doing nothing is a decision. It's a decision to let inflation slowly steal your wealth. It's a decision to stay poor while other people get richer. And it's a decision you'll regret when you're 70 years old and you realize you had decades to build wealth and you wasted them being scared. Let me paint you two pictures of the future. Picture 1, it's 2036. You're 10 years older. You followed this plan. You moved your excess cash into investments back in 2026. You invested consistently every month. You didn't panic during the inevitable downturns. Your portfolio has grown from $56,000 to over $120,000, even accounting for some market volatility. You have real wealth. You have options. You can retire when you want. You can help your kids. You can live without constant financial stress. That's the future available to you if you act. Picture 2. It's 2036. You're 10 years older. You kept your money in cash because it felt safe. Inflation averaged 3% over the decade. Your $56,000 in purchasing power is now worth about $41,000. You lost $15,000 of buying power by doing nothing. Meanwhile, the people who invested, they doubled or tripled their money. The gap between you and them is now enormous. And you can't make it up because you're 10 years older and you have 10 fewer years to invest. That's the future you're choosing if you don't act. The difference between these two futures is the decision you make right now. Not tomorrow, not next week. Right now. Are you going to keep doing what feels comfortable and stay exactly where you are? Or are you going to do what's actually smart and start building real wealth? Here's what I want you to do immediately after watching this video. Go to your bank account, look at your balance, calculate 6 months of essential expenses. Everything above that number is excess cash that should be invested. Open a brokerage account if you don't have one. Set up automatic monthly investments. Start moving that excess cash into a diversified portfolio. Do it today, not next month. Today. Because every day you wait is another day inflation is stealing from you. Every day you wait is another day of lost growth. Every day you wait is a day you can't get back. Drop a comment telling me which step you're starting with. Subscribe so we keep working on this together. And if this helped you, hit like and share it with someone who needs it. I'll see you in the next video.